Laird Abernethy from GQG Partners. Welcome to the Equities and Growth Assets Symposium. Can you explain GQG's unique approach to research?
Yes, certainly. So GQG Partners invest in large to mega cap stocks, which is one of the most researched areas of portfolio companies in the world. And it's for that reason we suspect that it's very difficult to get a true information advantage on these names. We're therefore shooting in our research process for what we call a context advantage on these names. And we do that by having two types of research teams, a traditional investment analyst research team and a non-traditional investment analyst research team. That non-traditional team has investigative journalists in there. It has forensic accountants, and it also has capital structure specialists. The journalist role in particular is quite interesting. It's looking at the ecosystem around the companies we research. So less so talking to management in the street, more talking to groups like ex-employees, suppliers, regulators, labour unions, to really get as broad and deep as research as possible for our portfolio managers.
And you have a forward-looking quality concept which mitigates what your approach. I'll start that again. You have a forward-looking quality approach. Can you explain that?
Yes, certainly. We would call our investment style at GQG quality at a reasonable price. But you're right, we think our approach to quality is a little unique when compared to some of our peers. Our peers tend to rely on more quantitative, backward statistical measures of quality. We're much more interested in the forward-looking quality of a company. So looking at a company's barriers to entry, the environment we're operating in, their pricing power in 3, 5, 7 years' time. It's a very qualitative process, but we feel it's a process that helps us strip away labels like value and growth and instead really try and find and focus on identifying the quality compounders in the market going forward.
What are the most interesting or powerful secular trends in the global markets that you're seeing at the moment?
So certainly if you look at our portfolio, it's probably pretty evident at the moment. We're well overweight to energy as a sector across all of our portfolios. We think on a forward-looking basis, there's some really appealing names in this sector. It's no secret that over the last 10 years, the energy sector has produced pretty mediocre returns. More recently, however, we've seen a significant imbalance between supply and demand in the energy sector. That's come about by, on the demand side, post-COVID, demand coming up to its pre-COVID highs for energy, and on the supply side, a significant underinvestment in capex by energy firms, which has led to this imbalance. When you couple with that the capital discipline that a lot of the energy players in this market are now showing, they're achieving record free cash flow yields and are paying that back to shareholders in dividends and also in share buybacks. So that's the investment thesis we feel for the energy sector. Now, obviously, there is also an ESG consideration with investing in energy, and we are completely committed to and recognise the need for the global economy to switch to a low carbon economy. We do think, and history has shown, that over the ages, these significant energy transitions take years, decades to undertake, and we're really at the beginning of that. We think energy companies, listed energy companies in particular, have a very big role to play in that transition. They've got the capital, they've got the infrastructure, they've got the time to help be a change agent to a low carbon economy.
What's the biggest underappreciated risk in global markets, do you think, at the moment?
In global markets, in terms of underappreciated risk, I'd say those companies that have earned excessively through COVID from the fiscal stimulus and monetary stimulus employed by governments and central banks. We see a lot of this risk embedded in, particularly in technology and consumer discretionary sectors, and we moved to aggressively rotate out of those sectors towards the end of last year. Look, as an example, Apple, over the last 18 months, that company's revenue growth has gone from mid-single digit to 35%. Now, if that revenue growth truly reflects the position of Apple, then Apple could be fairly priced. If, however, that revenue growth came about by one-off record levels of fiscal and monetary stimulus powering a aggressive consumer demand approach, then you would think that that revenue growth would peter off. And then going into an inflationary environment with increasing interest rates, we think for those companies that are over-earned at a high valuation, there's incredible downside risk from a multiple compression perspective.
Could you nominate one of the most interesting companies in your portfolio at the moment?
Yeah, certainly. So I think an interesting one is Walmart. It's one that you wouldn't see in a lot of other quality portfolios, but I think it truly reflects our forward-looking approach to quality. Walmart is the second largest holding in our global equity strategy. We have over 5% of the global equity strategy invested in Walmart. We think it's particularly interesting because of its bricks and mortar assets. It, in America, over 90% of the American population live within 10 miles of a Walmart store, which is just a phenomenal statistic when you think about it. So this bricks and mortar infrastructure is a real value add for their e-commerce business. And many people, I suspect, aren't aware that Walmart has one of the fastest growing and second largest e-commerce businesses in the United States. Coupled with that, with other competitors in the consumer staples sector, Walmart has incredible purchasing power. It's also a discount grocer, so we think there's a nice hedge there if economic conditions get worse in the United States going forward in particular. And then finally, I spoke about that risk of companies over-earning. We certainly can't attribute that to Walmart. Its multiple has stayed pretty consistent through the COVID environment. And at the beginning of this year, it was a 20 times forward PE for the firm, where others in that sector are anywhere up to double that.
Laird, many thanks for your time today.
Thank you.